So as we get started, I just posted this announcement which has the minimum requirements for your group presentations, which will be due for all the sections at 10 a.m. on Wednesday, May the 3rd. So it's a week from Wednesday. Okay? So on that day, you will need to submit a minimum of 6 files. Right? You'll submit 4 Excel files, your as is, your bull, your bear, your target. You'll also submit the PowerPoint that your team is going to be presenting, and you'll submit a Word or PDF document of the analysis and write-up of the group project. Okay? So remember that basically you're going to be doing 2 formats for your analysis. So one format is going to be verbal, the presentations, which is about half of your group project grade. The other half will be the write-up. So you're presenting the same information in just 2 different modalities. Okay. Now, what's also important is that everything be included as exhibits in both the Word document or PDF as well as the PowerPoint. Okay. So when you do your PowerPoint presentations, I will only let you present the PowerPoint file. And that is just out of fairness, because what will typically happen is Team 1 will present, everybody will look at Team 1 and say, oh yeah, I forgot to do that. And so Teams 2, whatever, will then start referencing other materials to fill in gaps that they quickly realize they forgot to put in. So in order to prevent that from happening, I'm only going to let you present what is actually in the PowerPoint. If you leave the PowerPoint presentation, I will ignore it, okay? And I will not give you any credit for that. So that means all the exhibits, all of the screenshots, even key parts of your Excel files, they must be put into that PowerPoint that is submitted on May 3rd. Okay? Same thing with your Word or PDF write-up. Okay? So put it into the appendix, or ideally embed it as you go through the document and you're writing up each of the sections, because the Word document is going to be graded without looking at the verbal PowerPoint. Okay? So the PowerPoint is going to be graded separately than the Word document. So when you do your write-up, again, same exhibits, same screenshots need to be in both documents. Okay? Now the Excel files are just supporting work. So the key parts of the Excel file, whether it's the CFI, the ROIC tree, or if you want to show pieces of the ratios, for example, or your implied multiples, that all has to be embedded in the PowerPoint in the Word document. So again, I put an assignment up here, or an announcement up here to help you with this. So what's going to happen is you will turn in by Wednesday, May 3rd at 10 a.m. all the files, okay? And then on Wednesday, May 3rd, 3 or 4 teams will present for 15 minutes, and then the remaining teams will present on Wednesday, May 10th, okay? So on Monday, May 1st, we will select the order. So you'll know whether you're presenting on Wednesday. And I will, A, take volunteers for who wants to go first, and B, try and accommodate based on any people who are having trouble being here for that date. Okay. Now, in terms of the PowerPoint presentation, you need to be here for both days, whether you're presenting or not. Right? Otherwise, you'll need a university excuse to not be here. I will take attendance on both days. And if you're absent either one of the days, you'll lose 5% of your semester grade per day that you're absent. So don't be absent. Okay. So just out of respect to your teammates, right? So I expect everybody to listen to everybody's presentation, so you will be here for both of those days, whether you're presenting or not. In terms of the presentations, in previous semesters, I used to make the entire group present. So if you had 7 people, you had to split the 15 minutes via 7 people. I'm not going to do that. So you can have as many people present as you want during those 15 minutes. Okay? So if you want to do the whole thing with 1 person, 2 people, 3 people, it's up to you as a team. You will get a team grade for the presentation. However, what's very important is, number 1, I'll ask Q&A, and every group will get at least 1 question, and any member of the team can answer that. And number 2, after we do the PowerPoints and you turn in your group assignments, I will do a peer review. And if your peers say that you did not fully participate in either of the group projects, then you could end up with a 0 for the entire semester. And if you lost 40% of your grade on the group projects, you will not pass this class. So what's very important is, if you're not presenting, that your team doesn't say that you didn't help out. Okay, so if you're not presenting, your team members must say that they are the ones that are presenting, but everybody contributed to create the presentation and help them present. Okay, so I don't want to see that happen, because in the past we've done this. I've actually had teams which have refused to put the name of some of their teammates on the presentation because they said they didn't do any work. Okay, and if one of your teammates says you didn't participate, probably not going to reduce your grade. But if 2 or more of your teammates say you didn't participate, then very bad things are going to happen to your grade. So I'm just giving you an advance notice. We're a week and a half out. I don't want to see that happen to anybody. So again, make sure that you are working with your team on putting these together. And as I said, even if you're not presenting, A, you should be here for moral support at a minimum, B, to answer questions, and C, make sure that you have contributed to the documents, even if you're not presenting the documents. By the way, this goes for stock track as well. Okay? Questions about any of that? Hopefully pretty straightforward. Okay. So during the 15 minutes, you must cover 4 sections. It's the same 4 sections we've been talking about all semester long. Section 1, EIC. Okay, so you should zoom each section somewhere around 3 or 4 minutes if you have 15 total minutes. So section 1 is EIC. Again, I want you to do what we call more the advanced EIC, which means you got to know your company, you got to know the industry. So as part of that, you got to talk about your beta. You got to talk about the industry spread using the operating spread. Okay, you got to talk about whether your company has competitive advantage. But as I said, don't just check the box. Give me insight into those and how they're going to change over 5 years. Right? Section 2 is historical analysis. You must show me an ROIC super tree for the industry, and you must cover the ROI super tree. You also must do a CFI analysis for your company, historical 5 years. Again, 3 to 4 minutes, both sections. Make sure you're referring to specific numbers. Don't be general. Right? Section 3, multiples. You must do a multiple analysis. And at a minimum, besides showing me all the multiples data, because I can't just hear you talk about it without seeing the multiples, but you got to rank your company and 2 others, just like we're about to do today with practicing with Walmart, Target, and Costco. So lowest to highest expected ROIC, including your company, explaining why. Valuation. Obviously, you're doing your as is, your bull, your bear, and your target. What are the key assumptions for growth, G, margin, and tax rate? Why did they change? What caused them to change? And assuming that you do the bull and the bear, making sure the implied multiples make sense for that range, and what is your final recommendation and why. Right? So that's where you'll be referring to what we did in the spreadsheets. So again, it's not different than what we've been working on for the last several weeks, but we're just going to be putting all of this together for whatever industry that you're focused on. Okay? So questions about any of that? All right, looking forward to hearing this and learning about your industry. Matter of fact, which industry you guys have again?
Retail.
Your retail. Okay, so today we're going to talk about Costco, and it's close to retail. And I actually thought when I did this that Costco is an incredibly predictable firm and this would be easy, but it turned out that it wasn't. Well, welcome to the real world. So in the past when we had done Costco, it was easy, but things are no longer as what they seem. So let's talk about Costco. We'll talk about the as is as a first starting point. So by the way, I put in the file section the screenshots and Excel files for Costco that are kind of a solution here. Okay. So let's open up Costco. So for the assumptions, I did mine this morning, but hopefully, did you get a whack of about 8.6? Sound familiar for everybody? Did you get a share price? It was about 171. It was 177, closed on Friday. Shares outstanding, 438.9. Estimated sales and EBITDA off the EEO, around 127, 134 and change. And then EV to sales and EV to EBIT of 0.55 and 16.92, somewhere in that range, which basically gave an estimated margin of 3.3%.
Yep.
Sound familiar? Okay. So with that in mind, we had to come up with some other data. So let's go here to the ratios. So the first one was the tax rate. Okay. I ended up putting in 35.3 because basically I think Costco kind of said that that's what they thought that the tax rate was going to be on a go-forward basis. So we used what Costco said in their recent earnings call as 35.3. But if you had said somewhere around 34, 35, I think that would be reasonable, even if you didn't look up the data. So that's where I got the 35.3 from. Okay? So that was that. Next, for operating income as a percentage of sales, based on this trading multiple, 3.3%. And if you actually look at 2018 EEO, that EBITDA 4.3 gets you 3.3, which basically we didn't really have to change much. So if you use the 2018 EBITDA going forward, that was about 4.3, right? I then looked at the ROIC on a go-forward basis, came up with something closer to 17%. If I did 17%, 16.5, 17, that gave me about a 17% ROIC. I put in 17, rounded off, and then that gave me a G of around 6.1. So G around 6. Okay? And then at a G of 6, I needed to then have growth rates close to 10%, somewhere between 9 and 10, to basically get the current share price, right? And that should have been the numbers that you probably started with. Everybody get somewhere close to that? Growth rates? Okay. But then here's the problem. I don't think Costco is going to grow at 10%. So, and I don't think the G of 6, that seems a little high to me. So there was the inherent problem. So I thought this was going to be easy, but then the numbers that are churned out, even in the as is, didn't seem to make sense. And I want to make sure it has common sense. That's why I said you can't always plug and chug. So I didn't ask you to do this. So when I quickly looked at this, I then went to the CFI. And this is why it's a really good example of why we would do a CFI analysis, right? And here's what I mean. If I looked at particularly the investment rate, 2016 is an outlier, right? And that's very important because we have been focusing on basically changing the income statement, and all through the semester I said leave the balance sheet alone because the income statement are the key drivers and the balance sheet grows with the income statement. But the balance sheet is growing based on the 2016 balance sheet. And for Costco, their 2016 balance sheet was an outlier where they were spending more than 105% reinvestment. So when you think about free cash flow has two components. It's got gross cash flow and it's got gross investment. Because the gross investment spiked, that high level of gross investment continuing into the future basically means we need even more gross cash flow to get the free cash flow. Hence, that 6% G and 10% growth rate, which to me seemed a little high because, as I'm sure you guys have been going through the retail analysis, every retailer is struggling, all right? And I'm not saying Costco is doing as bad as some of the others, but seeing them growing at 10% with brick and mortar stores is probably going to be challenged in any environment. And that has not even been their historical growth rates. So again, what this led me to say is, this is why I think the homework assignment was tougher than I originally thought, because I think Costco is an example of why we would actually have to adjust the balance sheet. So previously, we've never adjusted the balance sheet. We've left it alone. But Costco is a circumstance where we actually have to adjust the balance sheet in order to get a reasonable as-is valuation. And the reason why is because 2016 is an outlier year. And carrying that outlier year forward in the balance sheet ratios was making the gross investment too high, right? So that is where I made some changes. So where did I make changes? Well, what I did is I looked at the historical rates of reinvestment. And I also wanted to understand what was driving it, right? So I actually asked the last class, what was driving the 2016 reinvestment? So did anybody, by the way, look up the BICO or look up Costco to figure out what they spent a lot of money on in 2016? Yeah.
New store openings.
To what?
New store openings.
Part of it was new store, but they said something else. Yeah. E-commerce. is that they made a big investment in building out their e-commerce platform. And I'm sure, again, if you guys are doing retail, you're learning about omni-channel and how you have to have both e-commerce and stores. And I think that's what you saw, is that Costco made a big investment last year in building out their e-commerce platform. And so that's the point, is that alerts us that the store growth is probably not going to be as high in the future, because they know that they need to grow more online than brick and mortar. So here's the point. If you did the analysis, you start to realize that, number one, they made a big investment in e-commerce, and number two, that probably means that they're not going to have huge, giant store openings going into the future. So the idea of that very high reinvestment rate suggested that we were investing too much in the future and we had too much gross investment. So what I did is I had to lower to what I thought was a more reasonable gross investment. So again, if I looked at historical levels, somewhere in, this was 30 and then the 40s seemed more what they were doing historically than the 100. So I ended up reducing it to below 50%. In fact, I got down, might even be a little high, but I got down to around 48% investment rate, as opposed to 70% investment rates, which is what it would have been if I didn't adjust the balance sheet. Okay, so here's how I also decided to adjust the balance sheet. So I went back to the ratios, and I noticed two things. Number one, their accounts receivables were extraordinarily consistent, so I didn't change those. Their inventories were extraordinarily consistent, so I didn't change those. What was changing is their net fixed assets. There's the stores, there's the IT infrastructures. And basically, it went from a low of 13, and they were in the low 13s, to 14.5. That was the spike. And so that was the point. When you carried forward, you can see this here, 14.4%, then that probably left you with a pretty big gap with the current share price. So the way you would have made up the gap is you would have had a lot of revenue growth, right? But I just thought that was too unrealistic for that size company with all the challenges in retail to grow at 10% a year. So what I did is I made two assumptions. Assumption number one is I made this closer to 12, right? Now, I did this based on gut feel, but here's the idea, is I made two assumptions that led to 12. Assumption number one, that they are experiencing store challenges in growing the amount of stores like the rest of the industry, and I don't think they're going to open up quite as many stores on another basis. Number two, if they say they're investing in e-commerce, that they see more growth through e-commerce in the future, which also suggests less stores and more productivity. So I didn't cut it too dramatically, but I did cut it a little bit lower than historical rates, and that got me closer. I was within $15 of their share price with a 5% growth rate. Now, here's the next thing I changed, accounts payable. I did notice that last year they went down to 9.4% AP after being in the mid-10s historically. Okay, so basically having less accounts payable means more capital. So rather than getting the PP&E down even further, what I did was I went to a 10.3%, which is where they were in 2012, accounts payable, up from 9.4. So I added about 90 basis points back to AP to get closer to their 6-year industry average trend. That got me another, and you can see the difference here, which look at 9.4 versus 10.3. That was about $10 worth of share price. So I basically got about $24 or $25 worth of share price at a 4 to 5% growth rate by basically reducing their gross investments. And I did it through PP&E and AP. Yes?
So I get the PP&E decreasing that because you don't think they're going to invest as much, but what's the fundamental logic for decreasing accounts payable?
Well, increasing accounts payable.
I mean, increasing accounts payable.
Well, number one, I'm looking, and I know this is not ideal, but I'm looking at where the trends are more historically. And again, I started to treat 2016 as an outlier year. And the two big outliers that I saw with Costco were big changes in accounts payable and big changes in net PP&E. And so the other part is my own real world experience. generally companies, particularly retailers and people working through the chain, have used not paying their suppliers as a source of financing, especially in a very low margin cutthroat business. So again, I think that that's what Costco is probably doing. And so again, they're no different than a Home Depot, no different than a Lowe's, no different than a Macy's. Like generally people don't pay you in 30 days anymore. People pay you in 90 days, 120 days, and they don't really give you discounts. So when I saw the 1% of sales change for Costco, I assumed that that was probably more temporary than long term. So you could have made a different assumption, but that was the reason why I did the AP, is that most companies are trying to exploit their suppliers. I don't think Costco is any different, and particularly their low margin business. Because here's what's surmising all this: I didn't change their margins. And the reason I didn't change their margin in the as is because I did look at the trading margin of the EV to sales to EV to EBIT. So I was left with two choices. I either had to find a way to adjust the balance sheet down, or I had to adjust the revenue up. And here's the thing: when we built the model, in an ideal model, we'd actually be directly forecasting the reinvestment rate. That would have actually been a better model to build. But the reason we didn't is then we wouldn't have forecasted balance sheets. So what we did is we forecast the balance sheets to basically back into a reinvestment rate. So I needed to adjust the balance sheet to get a reinvestment rate that was, in my opinion, below 50%. And I'm still at 49%, which is a little bit higher than where they had been historically, right? But I think, as I said, I wanted to go closer to historical trends. And those were the two outliers I saw for 2016. It was PP&E and AP. So those are the ones that I played with. But to be honest with you, if we think about it on a pure cash flow basis, changing anything that gets me below 50% is probably more important just to fundamentally value them. Because I don't think the market expects them to spend over 50% in the as is, just given everything else we've started to learn about the retail environment that we're in. And they're signaling that e-commerce is a way to grow, and that's a much more productive way to grow than just opening up a bunch more stores. Yeah.
We just got an email that they're closing school at 1 p.m.
Yeah, they were
Oh.
closing for
Okay, then we will be closing in 4 minutes. So real quick, I'm glad I'm recording this, by the way. Is there a safety issue in this building?
Air quality.
From the fire.
Yeah, okay, but I'm saying it's not like emergency shutdown now. We got about 4 minutes. Okay. All right, yeah, we will be closing soon then, respecting that. Yeah, it was pretty bad even at 11, so I guess it's probably gotten worse.
inside my apartment building in Terrapin Road, so.
Yeah, so find a place not by there to go. But real quick, I will say, and I did record this, the answer for the multiples should be highest Costco, Walmart 2, Target 3, right? And the short answer is this is a little bit trickier, but basically what I base this on as well is you saw conflicting data with price to book and peg for Costco and Walmart, and for Target, because they had a negative growth rate, they don't have a peg, right? Because of negative PE, or PE divided by the negative growth in earnings, you don't get a peg. They don't have negative pegs. So a little tougher. The price to books suggests the ranking that I just said, but here's the thing. What I know is when I did the estimated margin, Costco has the lowest estimated margin and a high growth rate. But what we do also know about Costco is they are very efficient with their facilities and their super warehouses, even more so than Walmart. And so what I basically said was what explains this to me with essentially EV to sales a little bit higher is a combination of higher ROIC and higher growth rate, which probably explains these higher multiples. And that is more consistent with the higher price to book. For Walmart, I basically said that Target was a lot worse, that even though they had lower growth, they basically had high margin lower growth, which suggested a lot of productivity problems. And so as Walmart gets more into the traditional retailing side, particularly clothing and other stuff, more so than you'd see at a Costco, I think, and Target is also starting to close some stores, that is for the, even in this industry, which you guys are talking about, I saw Target as being lower expected ROIC, even though they have better margins, because I think they're having some same store sales issues and growth challenges. And they also had the lowest price to book. So those three led me to the conclusion that I did. Costco 1, Walmart 2, Target 3. Yes?
Would there be a way to like equalize the EV multiples for growth in the same way the PEG does for price to earnings?
Don't know. Let's pick this up on Monday, just in the interest of time.
Okay.
All right, so I will post this video. Remember, no lecture on Wednesday. I'm giving you, and this was the final homework that's graded. So Wednesday, work on your team projects. And then Monday, we'll come back and do a final check-in before the teams are due a week from Wednesday. Okay? All right, be safe. Whatever you do, please be safe.